Well, it's a very good morning from him, and of course it's a very good morning from me. Welcome to my mortgage live stream, or financial advice live stream, depends how you look at it really. Maybe I need to change the title. It's a little bit like generic really, isn't it? But welcome to my Monday session where I keep you updated with what's going on, give you some new ideas, new tips, techniques, some technical updates for anybody in the mortgage sector and the financial advice sector as well. Because the two are merging together again, aren't they? They separated a few years back, about 20 odd years ago, and now they're coming back together, and we'll see, because next year lots of regulatory change coming in. But I'll keep you posted of such things as well. Hope you're good. It's the 3rd of November, really into autumn now. I call November late autumn as far as I'm concerned, because it's a wet, steely grey, horrible month really. I was doing some training last week to some guys in the Middle East. It was an insurance company over there, doing it online. And of course they were basking in 29, 30 degree beautiful sunshine. And I said to them that we've got steely grey skies outside. They just laughed. They're mostly expats. They do remember the British weather. But enough of that. Why do we always talk about the weather when it comes to things like this sort of thing? A couple of great topics for you today. I've got a little tip for you about planning and goal setting and stuff like that a little bit later. But my main topic today is quite an interesting one, quite a scary one actually. I wanted to update you, tell you what's going on. You've probably read about it, but I want to make sure that you're comfortable with the implications of this one as well. Because we do need to be ahead of what's going on, which is key to the whole thing. So hope all is good with you. Hope you're well. Hope you're shining and enjoying yourself, and looking forward to the budget on the 26th of November. Not, but I hope you are, because that way things will start to pick up again afterwards, hopefully, because it's all a bit sort of stagnant at the moment in the market, isn't it? Waiting for the longest budget call ever known by mankind. Give us 3 months to think about it, Anyway, enough of that. Let's get into my first topic then, which is quite an interesting one. I think you'll find this quite insightful as well. So I'm going to pop over to the whiteboard for this one mostly. So let's just pop across to the whiteboard and we'll talk about it. Okay, what's my topic to start with then? Well, I want to talk about the shadow banking situation and mortgage lending to see where the links and the implications are. So I want to tell you about how shadow banking now works compared to traditional banking. Let's just take a look at some images up here for you. So first of all, over here we've got the traditional banks. When I say traditional banks, you've got the banks here in the UK, of course. You've got the banks around the world. These are traditional banks, highly regulated, often in the press, massive institutions, make good profits, shareholder value, that kind of stuff as well. And of course, traditional banks, as you can appreciate, they provide loans and business to businesses, companies. So let's just put those. So various businesses of various sizes receive loans from traditional banks, have done for years. Obviously banks also lend to consumers as well. Many of you deal with the high street banks when it comes to mortgage lending. You use them for mortgage lending, and many of the UK ones are making good money from that as well, but they lend to businesses. Now the thing about banks, of course, or traditional banks as we'll call them from now on, is that they are massively regulated, highly regulated, and rightfully so, because that's the nature of the beast, isn't it? But there are also lots of requirements. The most important one is they have these massive capital requirements now, which means that they must maintain a fair bit of cash, if you like, to support all the lending that they do. And they're heavily regulated, they're always under scrutiny, ever since the financial crash, of course, in 2008, even more so than ever before. And that's just the way the market has worked. Now, since that all happened, there's this other banking group coming through now called shadow banks. Let's just put those up there for you, shadow banks. Now, the phrase shadow banks is quite mysterious, isn't it, really? Think about it. And it kind of insinuates in the back, in the shadows, dark and mysterious. And it kind of is, really. Shadow banks then, a little bit mysterious kind of situations, really. And we need to make sure that we understand what they're like. So first of all, how does a shadow bank work? What does it comprise of? Well, it comprises of what we call private credit. Here we are. Let's put that in there for you. Private credit. Now, private credit is basically money that comes from other sources, really, that is given the phrase of shadow banks, which they then lend. And the whole point about private credit is they lend to businesses as well. They do lots of loans to businesses. So where does private credit come from? Well, it comes from anywhere that's not a bank, effectively. So you've got massive fund managers in the US, for example, and the UK, such as Apollo, Blackstone, ARES. These are huge organisations which hold trillions of pounds and dollars of money that's invested, and they're using that money to lend to banks, almost in the way that the bank would do it. Sovereign wealth funds are another example. Around the world, you've got countries in the Middle East, got Norway, places like that have got money owned by the government effectively, usually from oil or something like that, and they lend to businesses as well. And that's known as private credit. Now, private credit is completely different to, well, shadow banking, but that's the same thing, isn't it? It's completely different to traditional banks because they're not regulated in the same way. They do have similar regulation, but not in the same way at all. So there's much less regulation with private credit. Let's put that for you. So in other words, they can do all sorts of different things, much less regulation, which is worrying in a way, isn't it? Loose lending practices as well. They don't have the same capital requirements. They don't have the same rules that the main banks have when they lend to businesses. And they also lack transparency as well. They don't have the same transparency requirements that banks have, the main lenders, traditional banks. So they kind of do a lot of lending to businesses, and they're lending a lot of money. I read the figure of $3 trillion has been lent to businesses in the US from these private banks, this private credit. And that's a lot of money. And you're hearing one or two organisations that have gone bust, businesses that have gone bust with private credit money. And of course, it's you can imagine what's going on. These businesses, rather than going to a traditional bank for their borrowing, they go to private credit for their borrowing, which has much looser lending practices, much looser rules, and they can probably borrow more, and therefore they've gone bust as a result of that. So lots of things going on. So let's just take a look at some of the press articles you might have seen, and then we'll have a quick summary of the differences between the two, because I think these are quite interesting actually when it comes to it. So let's just take a look at the shadow banking thing. Here's one from the Telegraph. HSBC on alert over fears of shadow banking crisis. So obviously HSBC is a traditional bank, and they're thinking there's a shadow banking crisis coming up. It's on alert for a possible shadow banking crisis as concerns about private credit industry grow. So there's an article there for you from the Telegraph. Here's one from This Is Money. Citi piles billions into shadow banking despite risk of cockroaches. Finance giants on the back foot amid fears their push into private credit could go horribly wrong. So that's another one that's come through. This is one that you might have read about from This Is Money. Bank of England boss warns shadow banking has echoes of the 2008 financial crisis, which is quite worrying, really. And I'll come on to that in a second for you as well to see what you think about that one. Here's JP Morgan boss Jamie Dimon, who was in the press recently, and he's the one that used the word cockroaches. More cockroaches will emerge after private credit sector failures. Because what's happening, obviously, they're lending to various businesses that have failed. Two US firms have collapsed, linked to the shadow banking sector. So it's all a bit mysterious, isn't it, when it comes to it? And that's the thing about shadow banking. It's becoming more and more known. They're lending a lot more, and there's a couple of businesses that have gone bust. And the big banks, of course, are worried about the fact that because they're so regulated, the private credit, private equity section isn't. So let's have a quick summary of the differences, and then we'll take a look at some of the implications that are coming down the line to see what you think of these. Here's a little table that I put together with the difference between the two, traditional banks and shadow banks, for you. See what you think. Traditional banks, of course, take public deposits. Shadow banks are funded by investors' private credit. So I mentioned the sovereign wealth funds, the private credit organisations. That's how they fund themselves. Traditional banks heavily regulated, shadow banks lightly regulated. At the moment, of course, they're all looking at these things. Traditional banks, transparent lending, completely transparent, whereas opaque lending practices at shadow banks. Because to a degree, if they're not regulated, they kind of do what they want, can't they, when it comes to it. Traditional banks offer mortgages and savings. Shadow banks only lend directly to businesses. They don't lend to consumers. at the moment. It's not a market or model they want to get into. And traditional banks have capital requirements, of course. Shadow banks have very little deposit protection. In other words, they don't protect the money with capital under the hood. So, okay, we get that, we understand that. So why the issue? Well, okay, if they're lending to businesses and those businesses go bust, well, that's the problem with the businesses. And traditional banks do the same. But what the private credit are now doing, and the shadow banks are now doing, is they're now slicing and dicing their securities. And that always insinuates a bit of a problem. So if I can just share what I mean by slicing and dicing. Say, for example, you have a big fund here. And these private credits and shadow banks are lending money to these institutions. And these institutions are obviously paying back the money on a regular basis. What they're now doing is that they're packaging them up as securities. Do you remember 2008, mortgage-backed securities? So what they're doing, they're taking all these loans and they're slicing them up and then they're dicing them further. That's what they call slicing and dicing. And they're making this a security in which can then be sold onto the market and used as capital by the main banks for their lending. Very much similar to what happened in 2007, 2008. So what you've got here, of course, a number of these loans all cut up into little chunks of different risk categories, and this becomes a security in its own right, a loan-backed security in its own right. That's then sold onto the market as a very valuable security, which will earn good interest, which the banks, of course, will gobble up. So they're starting to slice and dice, and that, of course, has echoes of 2008. When we had similar things done with mortgages, and we called them mortgage-backed securities. They're all changed now, of course, but back then in 2008, these mortgage-backed securities were full of all sorts of unnecessary lending to consumers, particularly in the US, where these banks had lost a lot of money from some of the lending they did back then. And these mortgage-backed securities some of them were worthless. Obviously, these are worth a bit more money because they're secured by lending to businesses, but it's only backed by private credit. They're the same rules. These guys, when they do that sort of thing, when they create securities, they have to follow various rules for that. So we could have maybe an echo of 2008. And that's always very worrying, isn't it? 2008, the financial crash. Because what happened then, of course, is the wholesale markets just ground to a halt, because once these securities start filtering around the marketplace and then bought and sold by everybody, the wholesale market stops lending to each other. And that's what caused the credit crunch, as we very well know. So, okay, what's the message to us? Well, we just need to keep an eye on what's going on, because we should. As advisors, as financial advisors, we should understand what's happening in this shadow banking arena. Keep yourself posted with news. But as a mortgage broker, you might find some of your lenders have private equity, private credit to supplement, to fund their mortgage lending, and then they turn those into mortgage-backed securities and then sell them on for more money, and then they lend that money. But many lenders have warehouse lines of credit and all sorts of different ways of getting their money. I'm not talking about the banks, I'm talking about the specialist lenders. So, find out a little bit more when you get your BDM pops around. Find out how they're financed, where does their money come from initially, before they start creating these mortgage-backed securities. Find out how they're funded is probably a good question to ask as well. Make sure you diversify with the lenders that you use. Don't just use 3 or 4 or 5 common lenders all the time. A lot of brokers do. Try and diversify your lending so you don't have all your eggs in one basket. Might be a good topic to get into later this year, as this just continues on and unregulated. That's the problem with 2008. It was very little regulation going on then, and these things just got created. So be aware of what's happening, really, is the key message. I hope you found that useful. Bye. There you go. Hope you found that interesting. It's quite a topic. I'll keep you posted as things are progressing on the shadow banking side of things, because I'm finding it really interesting to see what's going on and see what changes are happening. Of course, we're all focused on the budget at the moment, aren't we, at the end of November, to see what difference that makes to the world that we're in. Okay, let's go on to my last topic then, which is all about a skill, really, that you can think about using. This one's called How the 80-20 Rule Can Change Everything for You. Now, I first learned about the 80-20 rule created by an Italian economist called Alberto Pareto, way back in the 90s. I learned it in the 90s as a young lad in the financial services sector. Now I now apply it to many aspects of my business life, probably more than Alberto envisaged, so let me explain where I use it, and perhaps you might want to as well. First of all, number one, priorities. 80% of my results come from about 20% of the activities that I carry out. Now the trick, of course, is knowing which ones, those activities, are the 20% and not doing anything else. Play to your strengths is the answer there, but not always easy, I might add. Now, number two, decision making. 80% of your results come from 20% of your decisions. So reduce the number of decisions you have to make each day so you can concentrate on the right ones, and delegate, of course, to other people if you've got people to delegate to. Number three, clear goals. Concentrate on the 20% of the goals that give you the best results. You see, each year I drop the bottom 10% of my activities and my goals to ensure I focus on the top 20%. Number four, networking and business relationships. I now spend more time on 20% of my existing clients and customers that provide me with continual business. I spend more time with them than the other 80%. Same when I'm networking and building relationships, I try to focus on the 20% that make the difference. Number five for you, learning and development, CPD. You can't do everything. Focus on the 20% of the skills that I want to develop that will make a difference. That's the key message there. I focus on my efforts on these rather than everything else and try to learn everything, because you can't learn everything. AI can do that, humans can't. So focus on the things that make a difference to you. I'm sure you can make or think of many, many more uses for Pareto's principle than Alberto envisaged way back in the 19th century, I believe. Great, hope you enjoyed that one. A little update for you on a little sort of time management planning principle as we go along with those things. Had a good webinar last week on the DIP-FA. We've reinvigorated our DIP-FA bootcamp, which allows you to become a financial advisor. So if you're interested in that one, make sure you let me know what your plans are. As always, we've got our little QR code here, so you can get onto our membership list and we can tell you a bit more about our DIP-FA and what's going on. We've got lots of exciting things happening, but we're promoting the DIP-FA bootcamp quite a bit at the moment. Obviously, CMAP's changed. People are going through differences in what's happening in the CMAP world as well, so that's something to keep in touch with as well. Other than that, I'm going to wish you a fantastic couple of days. Enjoy the dark evenings and the dark mornings. I'm sure you will too. And we'll catch you all next week. Bye for now.